Hello friends, in this session, we will going to cover major KPIs and key terms which you must know if you are working into a service-based company. Management guru Dr. Peter Drucker said, if you can't measure it, you can't manage it. KPIs are the best way to measure the result of the managerial decisions within your professional service company. You need to be careful and attentive when it comes to the KPIs you will use to track your business. It is suggested to choose the maximum of 7 to 10 KPIs on the program level or within a specific portfolio. If you choose any more than that, then you can cause the analysis paralysis syndrome. Friends, before we start, small request. Please subscribe for more valuable content for project managers. And in the end, don't forget to hit like button. Your one like is a big motivation for us. So without further delay, let's start. Okay, friends. So very first KPI is time utilization. So in a service company that sells the work hours of its billable staff, as a result, managing employee time is crucial. Time utilization is the perfect indicator to measure the productivity of your employees. Time utilization shows a share of your time work on client-related projects that is known as billable hours in a total paid time. In order to have fully control over time utilization, the companies use the simple billable hours trackers. The particular formula which you have seen on the screen is related to gross time utilization. So if you want to calculate the net time utilization, you can use total hours, including day off, in place of work hours. Let's move on. The next one is billable rate. Billable rate is the hourly rate at which the client is billed for the work performed by your employees. When you agree a fixed fee with your client, it is very important to calculate the actual billable hourly rate by dividing the total fee with hours spent on the project. Then you can check how much the actual billable rate differs from the planned billable rate. In order to optimize billable rates, companies need to understand essential rules about billable hourly rate management. Let's move on. The third one in the list is employee billing rate. So the employee billing rate is an hourly rate billed to the client for a specific employee. By comparing actual billable rates per employee, you can realize who are your top performing employees. The next one in the list is project billing rate, which is an hourly rate billed for a specific project. The billing rate is crucial for calculating the profit of each project. The next one, a very important one, is gross margin rate. Now, the gross margin rate is calculated as difference revenue from sales and direct cost of service performed, also known as COSAP. Such costs usually include the cost of labor and subcontractor and should be allocated properly. This is the most direct indicator of profitability, that is, top level indicator in the profit and loss account that is shown at the top of PLL account. The gross margin rate should be compared with the historical gross margin rates. In the case your growth margin rate is increasing during a time, that means your sales is increasing more than salaries. The next one is commercial margin rate. Now the commercial margin rate is the next level of profitability indication. Commercial margin is calculated as difference revenue from sales and total commercial cost such as marketing, licensing, education, sales cost, etc. Now this is the most heard KPI, EBITDA. EBITDA, as you can see, it stands for earning before interest, tax, depreciation, and amortization. This is one of the most comprehensive measure of the company financial performance. This one type of net margin profit rate. It is usually used for company valuation as an approximation of operating cash flow. EBITDA rate shows how much dollar your company earns to $1 of revenue. The next one is net profit margin. The net profit rate is the bottom level profitability indicator. It measures how much net profit is generated as a percentage of revenue. The next in the list is contribution to growth. So if your business is growing, you need to know the structure of such growth. So for an example, your actual revenue are 500K USD, while last year revenue were 400K USD. So total growth is 100K USD. Let's assume you have 4 different service lines. The crucial indicator of each service line's performance is how much each service line contribute to the growth. So it's an important KPI. The next one is cost of salaries share. Now this is a typical structure analysis ratio. Such ratio numbers allow you to control a share of specific cost in the total budget, that is revenues. So salaries cost share is an important KPI for the professional service industry matrices and indicate how much dollar you need to spend on salaries in order to achieve $1 of sales. Besides these KPIs, a very important metric is also the cost hourly rate. The next one is ROI, Return of Investment. Now this will indicate how much dollar you can earn on $1 of investment. Return is usually equal to net profit or cash generated, while investment is an aggregate amount of business assets such as property, equipment, cash, receivable, inventories, etc. The next one is return of equity. Now, equity represents the net asset of the company. That is a difference between total assets and liabilities, such as loans, unpaid bills, etc. So return on equity shows how efficient your company is. The next one is revenue per FTE. FTE stands for full-time equivalents. This particular KPI shows how much income you build to the clients per one employee on an average. Before calculation, this KPI, you need to calculate your full-time equivalent FTE. The next one is project efficiency. Now, this project efficiency is an indicator of project overrun. It is an indicator that you are on a budget or not. Beside the cost, you can also compare the budgeted and actual time spent on the project or budgeted revenues and actual revenues. So for better project efficiency management, it is very important to track hours and expense per project. Besides project efficiency, you can calculate project profitability as well. So when you calculate a specific KPI that is just beginning, you need to make relevant decisions based on the results. But in order to do this, you need to compare your actual KPI with KPI achieved in the last period, budgeted KPIs, competitor KPIs. Monitor of these KPIs is not possible without a work hour tracking solution. So that we will see in upcoming slides. Okay, the next one is working capital. So working capital is the metric that shows the business available operating liquidity. You can use this knowledge to budget and fund daily operations. The next one is current ratio. Now this indicator shows the short-term liquidity of a company. In other words, it is calculated as the ratio of the current assets and liabilities. So current assets include cash, account receivable, and inventory. In other words, they are the assets you would be able to convert into cash within the following year. In a similar situation, current liabilities are due within a year, including payable accounts. In general, your current ratio being below 1 signifies the danger of not being able to cover its short-term liabilities with the convertible asset it possesses over the time. So the formula is current ratio equal to current assets divided by current liabilities. Okay, gross burn rate. Now this indicator shows how much available cash is used up for covering operating expenses. Loss generating startups are usually the companies that use this KPI. The height of burn rate is inversely proportional to the time the company will take to spend its cash. In other words, the higher the gross burn rate, the faster you are going to run out of money. The way to prevent this from happening is by receiving more means or attracting new funding. Investors usually check this KPI while they are in process of deciding whether to fund a project or not. The formula for gross burn rate is given on the screen. That is company cash divided by monthly operating expenses. Now this one is debt to equity ratio. This KPI represents the ratio that indicates the amount of equity and debt a company uses to finance itself. It shows the capacity of shareholder equity for covering debt in case of a downturn. In other words, it is a measurement of the company's solvency. The formula is total debt divided by total equity. Now this one is days inventory outstanding, DIO. Is a ratio for working capital management. It gauges the number of days that a company usually holds its inventory before converting it into sales. Companies want their DIO to be low as possible, as that means their stock will remain up to date. Additionally, it also indicates that the cash is not trapped in inventory for a long time. Now, this KPI measures the number of days a company takes to collect payment for its sales. Business usually calculate their days sales outstanding or DSO for short per month, quarter, or year. You should use the following formula to determine the average number of days your company's accounts receivable take to realize as cash. Okay, this metric convert AP turnover into time. In other words, you can find out how quickly a company pays for purchases it obtained on vendor credit terms. The lower DPO, the faster the company is paying. And this is how you calculate day payable outstanding. Account payable multiplied by 365 days into COGS. Now cash conversion cycle This is an indicator that shows the time a company needs to turn a dollar it invests in inventory into cash it will get from its customer. The KPI accounts both for the time needed to sell the inventory and the time it needed to collect the payment after the sales. Similar to the previous KPI, you calculate it as a number of days. Okay, sales growth rate. Now, this KPI presents the change in net sales over time. The sales growth rate is represented as a percentage, and many companies consider it their most important revenue. It allows companies to compare their sales from the same period of the previous year or get an insight into their development from one quarter to next. A positive sales growth rate proves growth in sales. On the other hand, if the value is negative, the sales are going down. And this is how you calculate sales growth rate of your business. That is current net sales minus prior period net sales divided by prior period net sales multiplied by 100. Okay, this KPI shows the percentage of the sales revenue necessary to cover the selling, general, and administrative expenses. The S, G, and A expenses include operational cost. These can be advertising and marketing, administrative staff, salaries, rent, utilities, etc. Company aim to spend less money on these costs, and that is they want the SG and A ratio to be as low as possible. And this is how you calculate this particular indicator. The next in the list is interest coverage. Similar to the debt to equity ratio, interest coverage is a solvency KPI. It assesses whether a company is capable of meeting interest payments like bonds and loans. It does this by indicating the ratio of operating profit and interest expense. You want this ratio to be high as it proves your business will be able to pay off its debts without problems. And this is how you calculate the interest coverage. And last in the list is operating cash flow. Now, OCF is a metric that represents the total amount of money a company generates through its daily business operations. This KPI indicates whether a business can keep its cash flow high enough to grow. If the OCF is not doing well, you will probably need to get some financing from another source to handle your expenses. You can calculate the operating cash flow by adjusting your net income for elements like change in inventory, changes to accountable receivable, and depreciation. If you want to know whether your company is producing enough capital for its accounts to remain positive, this is the main KPI. Okay, friends, this is a part one of this series. I will bring more KPIs, which will definitely going to help you in managing your projects, portfolio, and programs. Hope friends, you have learned something new today. If you like this video, please hit like and don't forget to subscribe. Bye. Have a nice day.